Welcome to Money Depth Insights. I'm the finance guide, John Nell. Today, we're taking a clear and realistic look at how banks actually make money from credit cards, not through myths or assumptions, but through the real structure of the system and the real behaviors that quietly fuel it every day. Most people believe banks make money from credit cards simply because of interest, and while interest is important, it is only one part of a much larger picture. Credit cards are not designed around a single revenue stream. They are designed as ecosystems where small decisions, repeated over time, create predictable income for financial institutions. Once you understand this structure, credit cards stop feeling mysterious, and they start feeling logical. At their core, credit cards exist to solve two problems at once. They give consumers convenience and flexibility, and they give banks a steady, behavior-driven revenue model. Banks do not need people to fail dramatically to make money. In fact, the system works best for banks when people behave just slightly imperfectly, consistently and without stress. Let's start with the most visible source of income, which is interest, but we'll approach it from a practical angle rather than a textbook explanation. Interest is what banks earn when cardholders do not pay their full balance by the due date. What many people miss is that interest does not require reckless spending. It only requires small carried balances. Even responsible people who miss one full payment or choose to carry a balance for convenience contribute to this stream. Interest feels harmless at first because it grows quietly. A few dollars here, a small percentage there, nothing that triggers panic. But when balances roll over month after month, interest becomes reliable income for the bank. The system is designed so that interest compounds, while payments often feel flat. Over time, this difference creates a gap that benefits the lender far more than the borrower. What makes interest so powerful for banks is not the rate itself, but the predictability of human behavior. People underestimate how long balances will take to clear. They assume future income will make things easier. Banks price interest knowing that optimism is common and discipline is inconsistent. This is not exploitation. It is statistical expectation. However, interest is only one piece of the puzzle. A significant portion of credit card revenue comes from interchange fees, which most cardholders never see. Every time you swipe a credit card, the merchant pays a small fee to the card network and the issuing bank. This fee is usually a percentage of the transaction, plus a fixed amount. From the consumer's perspective, nothing feels different. The price looks the same. But behind the scenes, banks are earning money on every purchase, even when the cardholder pays the balance in full. This means banks can profit from responsible users as well as from those who carry balances. The card does not need to create debt to generate income. This is why banks aggressively promote card usage rather than card balances. More swipes mean more fees. More transactions mean more data. More data means better risk modeling and more refined offers. The system rewards frequency, not just indebtedness. Another overlooked income source is annual fees. While not all cards have them, premium cards often charge yearly fees in exchange for benefits like travel perks, insurance, or rewards. These fees are not priced randomly. Banks know that many people will not fully use the benefits, while still paying the fee every year out of habit. What's interesting is that banks are comfortable offering generous perks because they understand breakage. Breakage is the portion of benefits that go unused. Lounge visits not taken, insurance not claimed, points expired. These unused benefits reduce the bank's actual cost while maintaining the appearance of value. Rewards themselves are also part of the revenue equation. On the surface, rewards look like banks giving money back. In reality, rewards are funded through interchange fees and behavioral patterns. When people chase points or cash back, they often spend slightly more or shift spending onto the card that earns rewards. That extra spending generates additional interchange income, which often exceeds the reward payout. Banks do not need rewards to change behavior dramatically. A small nudge is enough. Over time, those nudges compound into predictable spending patterns. The bank wins not because rewards are unfair, but because human psychology responds strongly to incentives, even when the math is neutral. Late fees and penalty charges are another revenue stream, though they are not the foundation of the system. Late fees exist to discourage delays, but they also generate income when life gets busy or attention slips. Most late payments are not intentional. They happen because people misjudge timing, forget due dates, or assume minimum payments are enough. From the bank's perspective, these fees are signals as much as they are income. They indicate risk, which affects future interest rates, credit limits, and offers. Fees are part of how banks sort behavior and adjust exposure, while still earning revenue from small mistakes. Another subtle but powerful income source is balance transfers and promotional offers. Low or 0% interest offers attract people who want relief from high interest. While these offers can be beneficial, banks structure them carefully. Transfer fees apply up front, and if balances are not cleared within the promotional window, interest often resumes at a higher rate. Banks rely on the fact that many people will underestimate how long repayment will take. Not out of irresponsibility, but out of optimism. This optimism fuels rollover balances, which return the account to standard interest rates later. Data is also an asset that credit cards generate continuously. Spending patterns, payment behavior, category usage, and timing all feed into models that help banks design better products, target offers, and manage risk. While this data is anonymized and regulated, it still has immense strategic value. The more you use a card, the clearer your financial profile becomes. This allows banks to extend more credit, price risk accurately, and cross-sell other products like loans, insurance, or investment accounts. Credit cards often act as the entry point into a broader financial relationship. What's important to understand is that banks do not rely on extreme outcomes. They do not need people to default en masse. The system is optimized for moderation. Small balances, occasional fees, frequent usage, and long-term relationships generate steady income without creating instability. This is why credit card marketing often emphasizes ease, convenience, and flexibility rather than debt. The system performs best when users feel comfortable, not stressed. Comfort leads to usage. Usage leads to revenue. From a real-world perspective, the people who struggle most with credit cards are not those who overspend once, but those who drift slowly. They carry small balances, miss occasional payments, and rely on future income to fix present decisions. These behaviors are common, human, and statistically predictable. On the other hand, people who understand how banks make money can choose how much of that system they want to participate in. Paying balances in full avoids interest. Using cards for planned expenses still generates interchange fees, but those fees are invisible to the consumer. Choosing cards intentionally allows people to benefit from protection and rewards without feeding the most expensive revenue streams. This is not about fighting the system. It's about understanding it. Credit cards are not traps by default. They are tools with incentives. When incentives are misunderstood, outcomes feel unfair. When incentives are clear, behavior becomes intentional. Banks make money from credit cards because the system is built around behavior, not morality. There is no judgment built into the structure. There is only probability. The more closely behavior aligns with predictability, the more profitable it becomes for the issuer. The most powerful shift happens when people stop asking whether credit cards are good or bad, and start asking how value flows through the system. Once you see where money is generated, you can decide where you want to participate and where you want to opt out. In the long run, credit cards reward awareness more than avoidance. They punish confusion more than mistakes. And they benefit banks most when users remain slightly disengaged from how the system works. When you understand how banks make money from credit cards, you gain leverage, not fear. You stop reacting emotionally to statements and start reading them strategically. You stop chasing rewards blindly and start aligning tools with behavior. If this explanation helped you see credit cards more clearly, share your thoughts in the comments. And if you believe this understanding can help someone in your colleague or friend circle, make sure to share it with them. Education grows when knowledge is shared. This video is created for educational purposes only. For more calm, practical, and long-term financial understanding, subscribe to Money Depth Insights. I'm the Finance Guide, John Nell, and I'll see you in the next session.